Welcome to the CLS Monthly Market Review. I'm Rusty Vanneman, Chief Investment Officer for CLS Investments. And with me this month is Josh Jenkins, Senior Portfolio Manager. Welcome, Josh.
Thanks for having me.
We have a lot to talk about, a lot of exciting stuff. So last month, the winning streak has stopped. Our first loss in the stock market in over a year, the deepest correction, the first correction in 2 years, the deepest loss in 2 years. Everything was down, including your fixed income markets. Tell me about the fixed income markets.
Yeah, so in February, we saw the 10-year yield increased about 16 basis points, and sort of with that as our backdrop, the domestic bond market was down about 1%. We saw shorter duration bonds tend to outperform, longer duration, longer maturity bonds tend to underperform, emerging market bonds as well underperformed.
You know, it should be said that the markets were down and diversified portfolios were still down. CLS actually had a pretty decent month. I mean, in terms of relative terms, you know, take relative performance where we can get it. But again, our emerging market overweights basically really did help quite a bit. Right. So I think basically all the strategies did pretty well on a relative basis. We definitely held up pretty well in the down market. Hey, something else that happened that was really exceptional was volatility. And you cover the volatility statistics for us. Tell us about volatility a little bit.
Yeah, so in 2017, it was extremely low volatility period. Through much of the year, implied volatility, utilizing the VIX, was at or near all-time lows. Yeah. And so sort of what we've seen end of January, beginning of February, was sort of a return to normality. We definitely saw a little bit of a spike, but higher levels of volatility, definitely the normal experience.
Yeah. And I think you just hit the key point. Things are getting normal. I mean, it's normal for the markets to take 2 steps forward and 1 step back, and that's kind of what we saw, I think. And the volatility was crazy low. I mean, it's the lowest since the 1960s by many measures, or the 1920s by other measures, or the least volatile ever. Depends how you want to cut the data. So it was definitely a very exceptional month. Well, something else has changed at CLS, and we are going to be rolling out a new investment theme. And so our new investment theme is be active. And basically what that means is that we believe there's going to be a resurgence in active management and that the ability to beat markets. Now, when I say that, there's really 2 things going on. I mean, first of all, I think a lot of people think active management is just beating the S&P 500. And that's a kind of a sloppy definition. But basically, a lot of people think active managers have not done well because they have not beaten the S&P, but a lot of them are actually doing just international stocks or smaller companies or whatever it is. The S&P has been the dominant asset class. There's going to be a rotation away from that. We've already been seeing that.
Definitely.
The better definition of active management, of course, is just managers competing against their actual primary benchmark, so international versus international benchmark. And we think that's even going to do better for active management there's 4 reasons, which I've written about in the latest weekly 3. Expenses are lower than they have been historically. Cash balances have been lower than they have been historically. Those are usually been drags on performance. And also there's going to be a rotation probably from larger companies to smaller companies and from growth-oriented to value-oriented, really because that's where the valuations are at, and I think that's where we're at in the cycle too. When that happens, actively managed funds should do better as well.
Sure.
That's on the equity side. You cover fixed income. How about in fixed income now? We use a lot of actively managed funds in fixed income.
Yeah, we definitely see a lot of value in active on the fixed income side, and there's a couple of reasons for that. Yeah. First and foremost, fixed income markets are much less efficient than the stock markets. You know, when you have these large firms, they have these very deep benches, can do a lot of that bottom-up analysis. Really allows them to add value through security selection. And then most passive fixed income products are going to track a benchmark that's going to have very narrow scope. And so active managers can and do take advantage of that larger opportunity set to add value.
So before I segue on to the next topic and our last topic, actually I want to mention a couple stats because I take every opportunity to mention them right now. But again, so when it comes to CLS portfolios, so comparing our portfolios versus the whole industry. So, and you've heard me say this a bunch of times, but you know, when you break down the entire ETF industry, 80% is in market cap ETFs, 20% is in smart beta ETFs, another big theme of ours, and 1% is in actively managed. So CLS, meanwhile, is only at 40% market caps, only a half weight. I think that's pretty remarkable right there.
Definitely.
We're over 40% in smart beta, so it's more than a double weight, and we'll probably hit 50% later on this year. And that means we're about 20% actively managed compared to the industry of 1%. That's a huge number.
Right.
And it's not only in fixed income where it mostly is, but it is also on the equity side. All right, well, so the last topic, and another big reason why you're here, because you do manage a very successful strategy in this space, is telling us about the current environment for income investors and what's going on in there.
Yeah, so we've seen an increase in interest rates, but for investors that are seeking a really high yield, it actually hasn't been that beneficial. There's some other sort of characteristics of the market right now, conditions in the market that have made it a little bit more difficult to generate income today.
Yeah.
That includes, the stock market's been on a tear, credit markets have been on a tear. Because of that strong price appreciation, we've seen the yields in those areas come down.
Yeah.
Closed-end funds, an area that we've used historically to help generate high amounts of income, because they typically trade at a large discount to their NAVs. They use leverage. Recently, we've seen those discounts really shrink and the cost of leverage go up. So generating those high levels of income has been a little bit more difficult.
Yeah.
We're having to take more risks than we have historically in order to generate that income.
I think you said everything there. And of course, what you're talking about is written up in the latest weekly 3.2s. But it's counterintuitive. Interest rates have risen, so you think it'd be easier to get yield, but all those other asset classes we get yield from are much more expensive than they are, and risk is just a lot greater. I think income-oriented investors in the first place, never appreciate the amount of risk they're taking, especially in the current environment. So it's a good message. Well, great. Well, thanks, Josh.
Thanks for having me.
We'll talk to you later, yeah. And thank you for your time and trust in CLS Investments.